For 70 years, the Federal Reserve's interest rate decisions were treated as the primary lever controlling inflation and economic growth. Raise rates, suppress demand. Lower rates, stimulate activity. It was simple, linear, predictable. That model is now broken, and most investors haven't updated their mental models to account for why. In this conversation, macroeconomic analyst Lynn Eldon presents a thesis that directly challenges conventional monetary policy wisdom. The Federal Reserve's interest rate tools have become largely irrelevant. Not because the Fed is powerless, but because the structure of the modern economy has fundamentally shifted.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Her gradual print thesis is critical to understand. Rather than expecting hyperinflation or a spectacular collapse, she argues the Federal Reserve will gradually expand its balance sheet over an extended period. When war broke out and markets panicked about accelerated money printing, Eldon's position remained: higher risk of faster expansion, but gradual expansion is still the base case. And months into the situation, that has proven to be the case. The semiconductor stocks have outpaced the geopolitical volatility, a signal that markets are pricing in structural transformation, not catastrophe.
Right. So a lot of things are still in play from earlier this year. All the kind of major macro overlays are still fundamentally the same. Fiscal dominance, the U.S. Structural trade deficit, the associated kind of broadening out of global reserve and currency trading practices. And of course, what's new is the war, the geopolitical implications and fallout from the war, as well as the more immediate kind of energy or commodity shortages. And so this is obviously still an evolving situation, so many things can change. Earlier in the conflict, people would say, well, does this impact your gradual print thesis? So I've been for a while saying that the Federal Reserve is going to stop reducing its balance sheet. It's going to shift toward balance sheet expansion, but that apart from a few scenarios, that expansion should be pretty gradual. And so when war break out, it's like, okay, are we entering potentially a faster scenario? And my view was, and I wrote about this, back at the time in a newsletter, that the risk for a more kind of accelerated scenario has increased, but it's still not my base case. That the gradual print is still kind of my base case. And months into this, that so far is the way it's playing out. That this is not materially affecting, deficits, money printing, kind of like the breaking of a stock market or the bond market or anything like that. And obviously, it challenged it in multiple ways, but it's still largely the same. If anything, the performance of some of the semiconductor stocks has out kind of paced, at least in the stock market, the impact. Geopolitically, I think that probably the biggest takeaway, not just from this one thing, but I mean, this is like the most recent kind of and most like in some ways shocking example. But basically, we are entering a more of a Wild West in terms of geopolitics. So instead of kind of the post-World War II, and then especially kind of the post-fall of the Soviet Union world, where you have, kind of a seeming stability of one particular hegemon. Obviously you have instability in certain markets, especially emerging markets, sometimes caused by those markets, sometimes actually ironically caused by the U.S. and like there are kind of meddling. But you still had a relatively kind of stable, rules-based understanding of the world, even if it wasn't always true. That was kind of the perception and somewhat true. But now we are kind of just more firmly entering kind of a eat or be eaten or Wild West type of scenario where Russia invaded Ukraine, the U.S. is kind of taking this unilateral action with Israel on Iran, and countries kind of look around, and of course all the tariff situations as well, and the trade wars and everything else. So countries looking around and saying that they need kind of plan Bs, they need resilience as part of their planning, because things can just happen. Things that would be considered low probability can just kind of happen, a week from now, a month from now, a year from now. So that kind of adds complexity to the global world of investing. It's good for kind of neutral assets. things you can self-custody, or things that kind of benefit from that chaos. But overall, it's the main forces still are at play. And then depending on how this resolves, I mean, yeah, many people have pointed out that the U.S. is at risk of a Suez crisis moment here, which is, basically when the UK was kind of shown to have certain firm limitations back in the 50s. The nature of war has changed. This has not gone nearly as easily for the U.S. as they, by all accounts, seem to have thought it would, and not nearly as easily as the operation in Venezuela was. And the world is watching that reality and saying that, if the biggest navy in the world can't get a strait open reliably, what does that mean for geopolitics? And that's kind of the world that we're at now.
We no longer live in that economy. The U.S. federal debt is massive. The fiscal deficit is enormous. Bank lending is moderate, not explosive. So when the Fed raises rates, they accomplish two contradictory things. They modestly slow down bank lending, but they blow out the fiscal deficit even more. Higher rates mean the government pays more interest on its debt, which requires more deficit spending or more debt issuance. That money flows back into the banking system, into money market accounts, into bond holdings, all of which is spendable money. Over the course of a year, that leaks into broad money growth and inflation.
So QE, I would say it's like a subset of money printing. Whenever the central bank is expanding its balance sheet, it's a type of money printing. They're increasing the base money in the system. Especially when it's combined with large fiscal deficits, that's when it tends to really impact broad money. Now, QE is more specific in the sense that it generally refers to buying longer duration assets, with priority. Before 2008, the Federal Reserve would gradually expand its balance sheet. It wasn't QE; it was very gradual, and it was done primarily on the short end of the curve. After we kind of had a global financial crisis, that's when we got buying up the long end of the curve. That's when we got buying of mortgage-backed securities and things like that. And some other central banks have even bought other types of assets. So what the current situation is, it's somewhat closer to kind of pre-2008 central bank balance sheet expansion, with the caveat that the balance sheet starting is a much larger share of GDP than before, because we have this kind of entirely new regulation framework around how much liquidity banks have to have. But it's kind of on that more perpetual but slower approach. In addition, it's primarily focused on the short end of the curve, although it does go out to 3 years. So it's not entirely T-bills, but it's T-bills and relatively short duration notes. And so it's not quite QE, but it is money printing. And so we have basically a gradually expanding base layer of money that facilitates the ongoing expansion of the broad layer of money, partially through fractional reserve bank lending and also through banks buying securities like treasuries. And all this is kind of just keeps the grease on the wheels. In late last year, there were various signs of liquidity stress. The central bank shifted toward this gradual print scenario away from a balance sheet reduction scenario, and those liquidity issues have largely gone away, even in the face of war, which is actually pretty surprising that the liquidity situation has remained pretty robust, despite, obviously some frictions, to say the least, in global business and markets. Yeah, I mean, they can always do yield curve control, or they can buy the long end of the curve to try to take supply off the market. I don't think we're really near there yet, just because it's very optically terrible to do that when you have above target inflation, especially without a really good reason. So in World War II, they could say, well, it's the Nazis' fault, right? So it's not great, but we have to win this war. A lot of this is like just accumulated and self-imposed now. There's no great enemy. They can try to make great enemies, but there's really nothing like that. So it's just like it's optically bad. The new chairman, as we kind of approach, he's on record kind of being hawkish on the balance sheet. So I think he's going to at least try to keep it from expanding too quickly. Now the chairman can only, he's only one vote on the 12-person FOMC. Some of the other changes to bank liquidity and stuff require even decisions outside of the Fed sometimes. But basically, there's a number of kind of levers they can pull. So they are in this kind of era of wanting ample reserves and ample liquidity for banks. They don't want them to be reserve constrained. One option is to create newer reserves. That's what they've been doing. Another option, which they've also done a little bit, is to ease bank regulations, the SLR specifically. That's the jargon way of saying it. Basically, they can ease bank regulations and say you can hold a little bit more treasuries with duration without being punished for it, in terms of like capital requirements and stuff. And so that lets banks buy a little bit more treasuries on fractional reserve, which is kind of like private sector QE. It's like letting the banks do what is effectively QE. If the Treasury Department decides to stop issuing so many T-bills, because they keep issuing an above target percentage of T-bills, despite the current Treasury Secretary having criticized the prior Treasury Secretary for doing that, he's still doing it. If they were to increase the duration and reduce their amount of T-bill usage, they could also reduce the Treasury General Account with the Fed, which is a slight reduction potentially in the Fed balance sheet. But really, this just moves around liquidity. Basically, it can be the central bank, it can be the Treasury account, it can be the commercial banks. There's a couple levers to pull, but the short end of it is that they're not going to let banks slow down bank lending because of reserve constraints. They're not going to let the Treasury market break or go illiquid for more than a very short period of time. That's one of those things. If that happens, that the next day they're having an emergency meeting and doing whatever they have to do to reliquify it. And most scenarios point to a pretty gradual and persistent scenario of that. And it might be a mix of a couple of those things. I think a combination of very gradual balance sheet increases combined with maybe some further easing of bank regulations is what will absorb all that Treasury issuance. And we'll see, and they'll kind of adjust it as we go. Right now, money supply growth, obviously, it always is a factor of inflation, but right now it's not like explosive. Primarily, right now, the inflation is you have that kind of background inflation from the money printing and from frictions in the economy, and then on top of that, we have the closure of the Strait of Hormuz. So you have shortages, which are causing inflation. The reason that the Fed's interest rates don't matter as much anymore. The best way to say it, I think, is they have a mixed effect. They used to have a pretty linear effect, which is that if you have pretty low federal debt, and if most of the money creation is coming from fractional reserve bank lending, then the primary goal of interest rates is to either accelerate bank lending or pull back on bank lending. So if you raise interest rates really high, it makes it harder for borrowers to borrow money, and so you generally slow down that lending. The problem is, we're not in the 70s anymore. We're in the 2020s, and so U.S. fiscal deficits are huge. The federal debt, the existing stock of it, is huge, and bank lending is moderate. So inflation is not happening because banks are lending at an above average rate. It's a pretty subdued rate, and so when they increase interest rates, they do to some extent slow down bank lending, but then they blow out the fiscal deficit even more. And that does flow into the economy in various parts. It flows into the banks, ironically. It flows into, anyone holding bonds, anyone holding money market accounts, which is spendable money. It's not quite as fast acting as like a stimmy check, but year over year, it does leak out into the economy and contribute to money supply growth. So they don't really have great tools. The tools are more like keeping energy abundant, promoting tech advancement, which is deflationary when it's successful. You to boost productivity, sometimes in pleasant ways and sometimes in unpleasant ways, like suppressing wages because a robot can do something and competes with humans now, but it's a type of disinflation. Those are the tools, and they're not really the Fed tools. They're more either private sector tools or government policies and incentives for those things, and those are the things that keep inflation high or low when you kind of persistently have this fiscal dominance that we have now.
In this framework, the path forward is neither a smooth, gradual print nor a catastrophic collapse. It is a headline-driven, day-to-day volatility machine where small changes in geopolitical risk or energy prices or technological progress can shift the entire calculus. This is the world Eldon is mapping: chaotic, structural, and fundamentally different from the 70-year order that has just ended. Lynn Eldon's framework requires you to think about inflation, interest rates, and geopolitics in a fundamentally different way than conventional finance teaches. The Fed is not in control. Fiscal policy is. Technology is. Geopolitics is. The Fed's job is simply to keep the lights on, to ensure the settlement system works and banks have reserves so credit doesn't seize up. This explains why raising rates has not crushed inflation, why the Treasury can issue unlimited debt without the bond market breaking, and why the most important decisions being made are not at the Federal Reserve, but in the halls of Congress and at the State Department.
Their primary role at the current time is they just operate the base layer. I mean, the dollar is defined basically as a direct liability of the Federal Reserve. Everything else is like a dollar IOU. So they regulate banks to various degrees. They operate the base layer. They operate the big, settlement network that settles over $2 quadrillion a year in settlements between banks, which sounds like a silly number, but that's the number because the gross numbers are always bigger than you think. But their interest rate policy now really is in the back seat compared to what's happening with fiscal policy, what's happening with wars and tariffs, what's happening with the speed of AI or if it slows down, what's happening with domestic energy policy. These things are what have a much bigger role than Fed interest rates on inflation. Wars contribute to bigger sovereign debts, but also sovereign insolvency can lead to more extreme decision-making where you have the U.S. get more aggressive in terms of taking over its own industry, or get more aggressive in terms of foreign policy and trying to push the problem elsewhere. And so, it's easier when you have an enemy to blame to explain why, why is gas high? It's their fault. Why is inflation happening? It's their fault. Why, if we're not doing it now, but if you do yield curve control, it's like, well, why aren't you letting the market set long-term rates? It's like, well, there's a crisis and we have to beat the bad guys. It's much harder to do when it's just accumulated self-imposed errors. And basically just a kind of a aging hegemon. And so we're in that more world of chaos now. And obviously we're in a headline driven market. Things can change, let alone month by month, but day by day, compared to a more linear type of regime.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.